The story you are about to hear sounds impossible. A flower. Not gold. Not silver. Not oil. A flower. Yet in the 1630s, a single tulip bulb in the Netherlands could sell for more than a luxurious house in Amsterdam. Fortunes were made overnight. Families mortgaged their property. Merchants abandoned common sense. Contracts changed hands dozens of times before a bulb ever touched the soil. And then, almost as suddenly as it began, it all collapsed. For centuries, people have pointed to Tulip Mania as the ultimate example of financial madness. A moment when an entire society lost its grip on reality because of a beautiful flower. But the real story is far more fascinating than the myth. Because this is not simply a story about tulips. It is a story about wealth, ambition, speculation, human psychology, and one of history's earliest financial bubbles. A story that reveals how people behave when the promise of easy riches becomes irresistible. And it all began with a flower that was never supposed to be there. To understand what happened, we must travel back to the Dutch Golden Age. The early 17th century was a remarkable period in European history. The Dutch Republic was small in size, but enormous in influence. Its ships sailed across the globe. Its merchants dominated international trade. Its ports buzzed with activity from dawn until dusk. Amsterdam was becoming one of the world's great financial centers. Wealth flowed into the Republic from Asia, Africa, and the Americas. New fortunes appeared almost overnight. Trade companies generated unprecedented profits. Banks, stock exchanges, and sophisticated financial instruments transformed the way people thought about money. For many Dutch citizens, prosperity seemed limitless. This was a society becoming increasingly comfortable with risk, investment, and speculation. And into this prosperous world arrived the tulip. Tulips were not native to the Netherlands. Their journey began thousands of kilometers away in Central Asia before spreading through the Ottoman Empire. European travelers encountered these striking flowers in Turkish gardens and became fascinated by them. Unlike many European flowers, tulips possessed an extraordinary range of colors and patterns. Some displayed dramatic streaks of crimson across white petals. Others blended purple, yellow, and red in combinations that seemed almost magical. When tulips reached Western Europe during the 16th century, they immediately became symbols of status and sophistication. Owning rare tulips signaled wealth, education, and refinement. At first, the market was small. Wealthy collectors competed to acquire unusual varieties. Botanists studied them. Garden enthusiasts showcased them. Then something unexpected happened. Certain tulips began producing spectacular flame-like patterns on their petals. Nobody understood why. These rare varieties became highly prized because no two looked exactly alike. Today, scientists know these patterns were caused by a mosaic virus that weakened the plant while creating its beautiful appearance. But 17th century buyers saw only rarity. And rarity creates value. Soon, wealthy collectors were paying astonishing sums for exceptional bulbs. A flower that once decorated gardens was becoming an investment. That transformation changed everything. As demand increased, tulips evolved from luxury goods into speculative assets. Merchants noticed prices rising. Investors noticed merchants getting rich. Ordinary citizens noticed investors becoming wealthy. The cycle fed itself. Each new buyer arrived not because they loved flowers, but because they believed someone else would pay more tomorrow. By the mid-1630s, the tulip market had expanded far beyond aristocratic collectors. Craftsmen participated. Shopkeepers participated. Brewers participated. Farmers participated. People who knew little about horticulture suddenly became experts in tulip prices. The most sought-after bulbs acquired names that sounded almost mythical. Varieties such as Semper Augustus and Viceroy became legendary. Stories circulated of incredible profits. A bulb purchased one month could be sold for several times its original price the next. Every successful transaction attracted new participants. Every rising price seemed to validate the belief that prices would continue rising forever. It is a pattern that would repeat throughout history. Whether the asset is land, railroad stocks, internet companies, real estate, or cryptocurrencies. The psychology remains remarkably similar. People stop asking what something is worth. They ask only what someone else might pay for it. And that is when danger begins. The tulip trade soon developed a sophisticated system of contracts. Many bulbs remained underground during winter months and could not be physically transferred. Instead, traders bought and sold future claims to bulbs. A contract might change hands numerous times before the actual flower was dug from the ground. In modern terms, these were derivatives, paper promises, speculation detached from physical reality. The market became increasingly abstract. People were no longer trading flowers. They were trading expectations. And expectations can become intoxicating. Imagine entering a crowded tavern in Harlem or Amsterdam. Merchants gather around tables. Contracts pass rapidly from hand to hand. Voices rise with excitement. Prices climb daily. Someone boasts of doubling his money in weeks. Another claims a rare bulb will soon be worth twice its current value. Everyone seems to be winning. Everyone appears convinced that prosperity will continue indefinitely. History has seen this scene many times. It never ends well. By late 1636 and early 1637, prices reached extraordinary levels. The most famous examples have often been exaggerated over the centuries, and historians continue debating the exact scale of the bubble. Some popular stories describe single bulbs selling for the price of Grand Canal houses. While not every sensational claim is supported by surviving records, there is little doubt that certain rare bulbs commanded astonishing prices relative to ordinary incomes. More importantly, speculative fever had spread widely enough to create genuine economic risk. The market had become detached from fundamentals. People were buying because prices had risen. Prices were rising because people were buying. The system depended entirely on confidence. Then confidence vanished. No one knows the exact moment. No dramatic disaster occurred. No invading army appeared. No plague wiped out the flowers. Instead, something far more subtle happened. In February 1637, buyers simply stopped showing up at several auctions. A few sales failed. Then more sales failed. Traders suddenly discovered that finding buyers was harder than finding sellers. Panic spread rapidly. If prices could stop rising, they could also fall. And if they could fall, every contract represented a potential loss. The realization spread through the market like wildfire. The same psychology that fueled the boom now fueled the collapse. Greed transformed into fear. Optimism became desperation. People rushed to sell before prices fell further. But everyone was trying to sell simultaneously. And when everyone wants to sell, prices collapse. Within weeks, much of the market unraveled. Contracts that once seemed like tickets to fortune became nearly worthless. Speculators faced devastating losses. Many agreements could not be enforced. Disputes erupted across the Republic. Courts and local authorities struggled to determine how these contracts should be handled. The bubble had burst. Yet here is where the story becomes even more interesting. For generations, Tulip Mania has been portrayed as an event that destroyed the Dutch economy. That interpretation is probably wrong. Modern historians generally agree that while many individuals suffered losses, the broader Dutch economy remained surprisingly resilient. The Republic did not collapse. Its trade networks continued functioning. Its banks survived. Its global influence persisted for decades. The famous phrase, "the tulip that crashed an empire," is more symbolic than literal. The Dutch Republic was not destroyed by tulips, but the event revealed something profoundly important about human behavior. It exposed the vulnerabilities hidden beneath prosperity. It demonstrated how speculative enthusiasm can spread through society, and it provided one of history's earliest documented examples of a financial bubble. That lesson would echo through centuries. The South Sea Bubble in Britain, the Mississippi Company collapse in France, railway manias of the 19th century, the stock market crash of 1929, the dot-com bubble, the housing crisis of 2008. Different assets, different eras, the same underlying psychology. People become convinced that the old rules no longer apply. This time is different. Prices can only rise. Risk has disappeared. History repeatedly proves otherwise. Behind the numbers and contracts were real human stories. A merchant who believed he had secured his family's future. A craftsman who invested savings accumulated over years of labor. A trader who borrowed money, expecting easy profits. A collector who genuinely loved rare flowers, but became trapped in speculative frenzy. These were not foolish caricatures. They were human beings responding to incentives, emotions, and social pressures. Many were intelligent. Many were experienced. Many understood risk. Yet they participated anyway. That may be the most important lesson of all. Financial bubbles are rarely driven by stupidity. They are driven by hope. Hope for a better life. Hope for quick wealth. Hope that opportunity has finally arrived. When enough people share that hope simultaneously, extraordinary things can happen. Sometimes those things create innovation and growth. Sometimes they create disaster. Often they create both. Today, the tulip remains one of the most recognizable symbols in Dutch culture. Tourists travel from around the world to admire fields bursting with color each spring. The flower survived long after the speculation ended. In a strange twist of history, the object at the center of the bubble retained its beauty even after losing its financial magic. The tulip never changed. People did. And perhaps that is why the story still resonates nearly 4 centuries later. Because the real subject is not flowers. It is us. Our ambitions. Our fears. Our optimism. Our tendency to believe that rising prices confirm our wisdom. Our tendency to ignore warning signs when everyone around us appears to be getting rich. The tulip bubble reminds us that markets are not merely systems of numbers. They are collections of human emotions. And human emotions have not changed much since the 17th century. A rare flower traveled from distant lands into the gardens of a prosperous republic. Collectors admired it. Investors chased it. Speculators worshipped it. Then confidence vanished and reality returned. History rarely changes because of a single dramatic battle or a powerful king. Sometimes it changes because a society becomes captivated by something beautiful, scarce, and seemingly valuable. Sometimes it changes because people convince themselves that prices can rise forever. And sometimes, the most important lessons in economic history begin with something as simple as a flower that never intended to become an investment, a flower that became a symbol, a flower that, centuries later, still warns us about the dangerous intersection of greed, hope, and human imagination. Because long after the last speculative contract was forgotten, the lesson remained. The tulips bloomed again. The fortunes did not.